Regional aviation is critical to the success of global air transportation networks. Roughly 50% of the world's flights operate on routes less than 500 nautical miles, which are well suited to regional aircraft. Regional aircraft play a vital role in connecting passengers to major hubs, in operating point-to-point on less dense routes, and are often the only suitable aircraft to operate in environments with constrained runways.
The regional aviation sector has shown to be more stable through economic cycles. The low trip cost of regional aircraft makes them optimal during times of decreased passenger demand and an efficient option to build new routes during upcycles.
Currently, fewer than 30% of regional aircraft are leased versus 50% of narrow and wide-body aircraft. We believe the regional market will migrate to a higher percentage over time as airlines focus on capital preservation.
Our size and scale positions us well to capitalize on significant industry growth. We have a total fleet of over 350 aircraft, and we are geographically diversified with our businesses and our customers operating on all 7 continents.
The origination of Chorus actually dates back to the 1930s, and our leadership team has helped shape the landscape of regional aviation in Canada and throughout the world. There is no management team anywhere in the world that has the years and depth of experience that the Chorus management team has with respect to regional aviation and its various roles and its assets.
Our collective team offers a full suite of regional aviation services, including pilot training, asset management and leasing, contract flying, special mission, aircraft modifications, and end-of-life disassembly and parts sales. Our capabilities enable us to maximize asset values and returns.
We have established long-standing partner relationships with a multitude of stakeholders, including airlines, equipment manufacturers, other leasing companies, lenders, government agencies, and fund investors. The acquisition of Falco is transformative for Chorus. It enhances our scale and regional aircraft leasing and diversifies our earnings by adding fees from an asset management platform that has an excellent track record of consistently delivering superior returns. Brookfield's investment and support provides added expertise in fundraising and asset management. The Falco team gives us an incredible new earnings pillar with a world-class asset management platform.
We know that the foundation of our success is our employees. A focus on safety, equity, diversity, and inclusion strengthens our competitiveness. Employees' varying backgrounds, identities, and abilities lead to a broad array of thought and perspectives, all of which add tremendous value given the global nature of our business.
Good morning, everyone. My name is Jolene Mahody, and I'm the Chief Strategy Officer with Chorus. I would like to extend a very warm welcome to each of you to Chorus's first Investor Day. And I know we have many analysts in the room who have been covering us for some time. And I think every quarter had asked us for about the past 15 years, are we hosting an Investor Day? So happy to do so today with all of you. I've been asked to just remind you, in case you didn't see it on the screen, of the Wi-Fi password. So the Wi-Fi password is King Edward 2023, and it's the Omni meeting. I'd also ask you at this time if you wouldn't mind turning your phones on silent so that we don't disrupt the meeting today. While the event is not being live webcasted, it is being recorded, and we'll be sharing this via our website shortly after the event. We plan to have a Q&A session at the end of this morning's presentations, and so we've allowed plenty of time for that. So if you can please hold your questions until that time, it would be much appreciated. I'll also remind you that today's material and discussion contain forward-looking information, And as such, I will direct your attention to the caution regarding forward-looking information in the notice to readers and endnotes, which are in the appendices of today's material. So we'll first hear this morning from Colin Kopp. Colin assumed the role of CEO in March of this year after a 30-year career with the company. He has held various leadership roles throughout his time with Chorus, and we're very excited to have Colin as our new CEO. Now, it is my pleasure to turn the podium over to our President and Chief Executive Officer, Colin Kopp.
Thank you, Jolene. Good morning, everyone, and welcome. Thank you all for taking time out of your calendars to be with us today. I've met with many of you, but I want to ensure I get an opportunity to connect with everybody, as you're all very important to us. Several of you have provided feedback to us over the past few months on the type of disclosure that you felt would be helpful today, and we really want to thank you for that. It's made a big difference for us in working our way through our presentations today. This is a very exciting day for us. Today marks a milestone in our history. This is our first ever Investor Day conference, and we're looking forward to many more in the future. A lot has changed in our business over the last year. We have a new chairman of our board. We have new board members. We have the acquisition of Falco. We have Brookfield as investors. And yes, we have a new CEO. We are absolutely shifting gears. And our goal today is to clearly lay out for you our vision and plans going forward, demonstrating how we're repositioning Chorus with decreased leverage, an increase in quality of earnings, a clear plan for growth, and ultimately unlocking shareholder returns. Let me start by briefly introducing our exceptional team of directors that we have on our board. There has been considerable change in our board since 2020. With 7 new members, if you include myself. With us today in the audience is our chairman, Paul Rivett, as well as David Levinson and Frank Yu. Amos Kazaz, Marie-Lucie Morin, Karen Cram, Gail Hamilton, and Steve Hannes and Alan Jenkins all send their absolute full support for today. Since my transition to CEO began in September of last year, myself and the team have spent a significant amount of time working with our board on our go-forward plans. And I feel extremely fortunate to have such a well-experienced board aligned with us, who is deeply invested in our plans and our vision going forward. Moving briefly to the Chorus executive. This is a team of exceptional leaders, industry veterans, who have collectively hundreds of years of experience in the regional aviation business. And you'll find the same level of experience exists within our subsidiary businesses. You'll hear more on that as our business unit presidents present their teams today. This team here has grown up in the regional business, has been through several industry cycles, evolving their organizations as customer and industry needs have changed. Our experience level combined with our organization's capabilities translates to our expertise. And it's our expertise that ultimately has been our currency to success. Turning to our updated statement on who we, on who we are, Chorus is a leading global aviation solutions provider and asset manager focused on regional aviation. You're going to see through the course of the morning that Chorus is truly a global leader, providing a very broad and expansive set of services across the regional industry. In fact, I'd argue that there is no other player in our sector who dominates the regional business the way we do. Nor is there another organization that has the knowledge and experience that Chorus and its combined group of businesses brings to the table. Throughout the course of the morning, you're going to hear about our strengths and capabilities that have really been the foundation of our success. But it's unquestionably, it's our people that are our most valuable asset. And our plans are based on leveraging those strengths and capabilities that you're going to hear about with our people to grow our business. I think, as you can tell, I'm very confident in our organization's ability to deliver on our vision and plans that we're presenting to you today. Chorus is a global heavyweight in the regional industry. We own, operate, and manage 350 regional aircraft. We have 240 plus customers around the world, many of whom overlap between our businesses. And with the acquisition of Falco, we are the world's largest asset manager and lessor focused on the regional aircraft segment. While our corporate headquarters is based in Canada, we also have a significant presence in the UK, Ireland, Singapore, with our leasing and asset management side of the business. And we have operational bases in all major Canadian cities and operate in many challenging locations throughout Africa. When you combine our offices, our operations, our customer locations, you can see that we are conducting business or have customers on all 7 continents, including Antarctica. Turning to our financials for just a moment, the figures noted here are for our most recent year end, 2022. You know, we've grown our earnings metrics over 2021 with a 30% increase in adjusted earnings per share and delivered an adjusted return on equity of 14%. We had strong cash generation, increasing our free cash flow by 128% year over year. And then towards the end of 22, what you saw was we started on the deleveraging plan, successfully redeeming senior debentures early, retiring about $115 million in debt. In fact, we reduced our leverage by 30% since June of 2022 to the current leverage of 4.4 net debt to EBITDA. We are planning further reductions over the coming years, and you're going to hear more from Gary on that shortly. But the key takeaway here is that our strong and stable financial position sets us up very well to execute on our plans, targeting accretive growth and returning capital to shareholders. Looking at our lines of business for a moment, as you heard in the video, our origins date back to the 1930s, with Jazz being the result of 5 merged regional airlines. And over the years, Jazz has operated everything from a Boeing 757 and down, 40 aircraft types. And they're recognized today as one of the leading North American operators. In 2015, we acquired Voyager as part of our diversification strategy, and Voyager comes with really deep operating, engineering, logistics capabilities. They're known for operating aircraft around the world with agencies like the United Nations. And most recently, last year, we acquired Falco and merged it with our previous leasing business, Chorus Aviation Capital. Falco is the #1 regional aircraft asset manager and lessor. And the Falco team has also, very much like our other businesses, grown up in the regional sector, with many of its employees having formerly worked with British Aerospace. And lastly, we just announced our partnership with CAE and launched Cygnet Aviation, our industry-leading flight academy headed by Lynn McMullen, who is one of Canada's leading flight training experts. The common theme that you see here is the deep level of experience that exists, our capabilities, across all of our businesses. How are we delivering greater value from our book of businesses? A common question we get. Business collaboration is inherent to the Chorus ecosystem. And the common connection between our businesses is aircraft platforms. To provide a few examples of the intercompany value creation, our Jazz Dash 8-300 fleet recently exited the Jazz CPA. It came out of the Jazz CPA as part of contract decisions and was purchased by Voyager for redeployment. And today, many of those aircraft have been modified, reconfigured, sold, or leased to new customers. As well, Jazz today is contracting Voyager to do their landing gear overhauls, component repairs, specialty engine service work. And Voyager has purchased all of the Jazz Dash 8-300 surplus inventory for the parts business. Voyager and Falco are both contracting Jazz, their JTS MRO division, their heavy maintenance division, to do heavy maintenance overhauls when space permits. And Falco recently sold 2 Embraer 190s to Voyager as they reached end of life in a fund, and Voyager used them to feed their parts supply business. And the last example I'll give, as there are many, Falco is contracting Voyager to store, manage, reconfigure Q400 lease returns as Falco repositions these aircraft to new customers. The intercompany activity is growing. And every day we see new opportunities for our businesses to create value for Chorus by leveraging across each other's capability and capturing greater revenue and margins. Our business is evolving to more of a free cash flow business. We launched in 2006 as an income trust with Jazz, and it remains today our core free cash flow business. Then in 2015, we acquired Voyager, and while it has taken some time, there's no question about that, Voyager today, and you'll hear more on this later, Voyager today is growing nicely with an absolute clear vision and is free cash flow focused. In November of 2016, we began acquiring aircraft and leasing them to airlines globally. And when COVID hit in 2020, the environment necessitated this immediate shift. Our priorities moved quickly, everybody hunkered down, and we all focused on preserving cash and building liquidity. And at this point, our balance sheet leasing business wasn't meeting our return expectations. And as the industry recovered, we could see the asset-light leasing model as having higher returns and a much better alignment with our business. So with the support of Brookfield, we moved quickly to acquire Falco in 2022. And as our combined leasing business under Falco evolves to the asset-light model, we see it getting back on track and are targeting mid-teen ROEs. It's going to also align much better with our other businesses as being free cash flow focused now. There are many things we've learned over the years, but the one thing that stands out for me in this case is that the road to success is always under construction, and that you absolutely must evolve to thrive. We are very well positioned with strong contracted revenues, and we have significant equity built up in our book of assets. And as I often like to say, long-term contracts and customer relationships are core to who we are and our business model. And when you combine our contracted revenues across our group of companies, the figure totals $2.5 billion, which is mainly the fixed fees and aircraft lease commitments. This is a big number, and it's also a number that's supported by very strong counterparty credits. And you can also see the significant net asset value that we've accumulated of $1.3 billion. So this is a good transition into the next slide. Let's talk for a moment about our share price. You know, the team has done a lot of work on our share price valuation, and we're trading today at a significant discount to our net book value of $4. Chorus is very unique. I think most of us know that, and we feel that. We're very unique. We have limited comparables. And Gary's going to share our views on how our business segments relate to multiples and comparator groups, which is what gets us to our intrinsic value of $550 from our book, our net book, 4 to $550. And Gary will talk about that here shortly. Then, as we execute on our plans, monetizing assets, we will generate significant cash. And the bridge that gets us from 550 to a much larger number is the redeployment of that cash used to reduce debt, build accretive growth, and return capital to shareholders. And as we do that, we're going to be focused on a mid-teen return on equity as a key metric that's going to drive our capital allocation decisions. The takeaway here for us is that there is significant opportunity in our stock price as we move forward with a very clear vision for Chorus going forward. I'm now going to turn to our key investment highlights. I'm going to spend the next few slides on our sector and our strengths so you can maybe appreciate our views on valuation a little better. I'll talk about our sector and its importance and criticality to commercial aviation, and touch on special mission markets, both civil and military. I'll also speak to our strengths in terms of size, geographic diversity, our assets, and our cash flow, and then kind of wrap it up a little bit on our strategic shift and business transformation. Regional aircraft are a very strong asset class. As you heard in the opening video, they have a very defining role throughout economic cycles. And a common misunderstanding here about regional aircraft is that the operators represent the lower end of the credit scale. this is not necessarily the case, as regional aircraft are widely supported by core operators, major carriers, flagship carriers, governments, etc. In fact, the top 15 major airlines account for approximately 49–50% of the total operational regional fleet. Generally in the regional space, there are very few speculative orders made by airlines or lessors, and this helps limit oversupply. This is further supported by a disciplined OEM production of new aircraft, providing a strong balance between supply and demand and somewhat protecting asset values. And lastly, you're going to see this in Jeremy's presentation later. Regional aircraft lease returns have consistently outperformed those of narrow-body and wide-body aircraft. Okay. So you should think of regional aircraft generally being defined as less than 150 seats, max certified seating capacity, so 149 and down. As we all know, they're fundamental to efficient air transportation networks and are principally used to serve smaller markets that don't have enough passenger traffic to support larger aircraft. However, they're also used on high-density markets at off-peak times, on low-density markets to build and stimulate passenger demand, and to operate bypass services of busy hub airports. And the regional aircraft scope has expanded in recent years. It now includes new crossover jets like the Airbus A220 and Embraer 195, which has expanded our core business. And these aircraft platforms are game-changing with their amazing fuel efficiency and long-range capabilities now of 6,000 plus kilometers. And you'll see these aircraft in our aircraft portfolio. They play a key role in the special mission operations as well, including military deployment, search and rescue, airborne surveillance, aeromedical, firefighting, cargo, where there's been an absolute real drive to less costly aircraft platforms. We've seen a lot of this shift in the last few years. And we believe that the scope of regional aircraft will continue to grow and evolve as technology and industry needs change. This is a great follow-up slide. This slide really shows how well regional aircraft performed following the pandemic. And as I mentioned earlier, they are extremely resilient and have advantages in both up and down cycles. And we're seeing this growing demand for the new crossover aircraft and special mission platforms. And the last point I'll make here, when you think of the 2050 net zero carbon emissions target in aviation, the investment in technology and propulsion systems, whether it's a hybrid electric, a fully electric, or a hydrogen, it's all being done in regional aircraft platforms. Regional aircraft will be the first aircraft to market that use propulsion technology that's new. And these zero-emission platforms will be critical to meeting the net zero carbon emissions targets. As a result, we have seen very large technology investments in this area and orders by several mainline operators for these new aircraft. This is, again, another area of growth for our business and further supports that the regional aircraft platforms are a strong asset class. Shifting gears for a moment, this is a map, simply a visual displaying all the areas we conduct business. You can get a good sense of kind of our global presence from the dots on the map. we do evaluate jurisdictional risk as part of our ongoing assessment. And today you can see we don't have exposure in Russia or China. I talked earlier about our plans to focus on free cash flow going forward. So now let's look at how we've performed from that perspective. We've generated $1.3 billion in free cash flow over the past 5 years. Our track record is supported by our businesses generally being business to business or business to government with limited commercial risk. And approximately 90% of our revenues today are secured through some form of contract, the largest of which is the CPA, which has contract revenues of about $1.4 billion. 2021 was a remarkable year for us, given the significance of the crisis, and we outperformed most other North American operators in 2021. The dip in 2021 is related to our restructuring of our CPA during that period, which most people will recall, and some aircraft lease returns. But nonetheless, a very strong year considering where we were. And of note, in 2022, the numbers there only have Falco from starting in May of 2022 with the acquisition. They're not in there for the full year. In summary, our free cash flow generation remains very strong, it's stable, and it helps position us very well to deliver on our plans. Looking at our portfolio for a moment, as this is a big part and an important part of our plan going forward, is our assets. We have a high quality portfolio of owned assets with significant equity built up in them. You're going to hear Gary talk about that and give more specifics on that here shortly. Our 200 plus portfolio of owned aircraft are on average 8.5 years. We have a fairly young fleet. And we're pretty much evenly split between turboprops and regional jets in terms of value. The key message here is that as we look across our businesses, we have a quality portfolio of owned aircraft that are well balanced and diversified in terms of aircraft type, geographical location, and customer. The acquisition of Falco was an absolutely transformative event for us, especially for our leasing business. We now have scale and a transition to higher quality earnings in reoccurring asset management fees. And we were absolutely very pleased to welcome Brookfield as a partner when they invested in us to support the acquisition. As they provide tremendous support, they have incredible experience and knowledge in asset management and the capital markets side of the business. And they have been an immense help to us. As well, as I mentioned earlier, we have 2 Brookfield representatives that sit on our board supporting our growth plans. The acquisition's been a great fit. And in a matter of months, we've integrated Falco as one of our core businesses, and we have a clear plan for growth. The newly combined book of business under Falco has brought new experience and capabilities. It has provided scale, it has reduced risks, and it has provided a path to higher quality of earnings going forward. Moving into the shift from on-balance sheet to asset-light. The asset-light model is a much better fit. And it's really Falco's deep experience that has enabled us to get there. And you'll hear Jeremy talk about some of that. They have a proven track record. They have raised close to $1.4 billion in equity since inception. And they have well-established relationships with many high-quality fund investors, such as state pension plans, sovereign wealth, and family offices. And they've been successfully providing mid-teen returns to their fund investors. As we've said, we will be co-investing in these funds on a go-forward basis, and Fund 3, we've committed up to investing up to 15%. And over time, with the shift to asset light, what we see is our balance sheet improving with lower leverage and the business becoming more free cash flow focused with a higher quality of earnings. And you're going to hear a bit more about that today from both Gary and Jeremy. Now let's just turn to the monetization of the assets and talk for just a little bit about Falco's capability. Falco has a proven history of opportunistically monetizing assets. We have over 3.2 billion Canadian of wholly owned or majority owned assets today. 2.1 billion Canadian is in our leasing segment. So to unlock value, we will sell these assets when and where it makes sense. Falco has a very strong record of doing just that. They've sold 185 aircraft over the past decade, generating significant cash. They have a full team dedicated to aircraft trading, and through their deep market knowledge have developed a systematic process of optimizing aircraft values. And we demonstrated this successfully, this successful execution of the strategy in the latter half of 22, when we sold aircraft to generate $200 million in cash, redeploying that cash to reduce debt and buy back shares. And this is exactly what we plan to do going forward as we execute on our plan and transition to an asset-light model. Capital allocation. We've adopted a more disciplined approach to capital allocation, and we will deploy capital to what provides best returns to our shareholders. We are generating significant cash from our core businesses, and we will add to that over the coming years as we opportunistically monetize these assets. We have a debt reduction target square in our sights, and we will continue to focus into next year with a targeted level of 2.5 to 3.5 net debt to EBITDA. We've been returning capital to shareholders through an NCIB, and we will continue to look at buying back shares so long as our share price remains undervalued. There are many shareholders, as we know, that have stuck with us over the years, and the dividend is important to them, and we will consider a dividend as we execute on our plan and our share price recovers. And keeping in mind our mid-teen ROE target, we will look at accretive acquisitions and co-invest in Falco funds. Continuing on and just touching on our growth agenda, we will continue to organically grow our core services. And the special mission area is a key priority for us at Voyager. The defense sector is particularly exciting, and many of you are aware Voyager recently secured a long-term contract with the Canadian government supporting a new manned airborne surveillance fleet. Airborne surveillance and reconnaissance platforms are typically regional, and this market is growing at a 6% compound average growth rate, and it aligns extremely well with what we do and our capabilities. We see this market as both an organic growth opportunity and also as potentially an acquisition opportunity, and you're going to hear a little bit more on that later. As well, Jeremy and team are keenly focused on Fund 3, and we plan to grow the regional aircraft leasing funds, as well as leverage the Falco team to expand into adjacent funds, such as green funds or debt funds. And you'll hear more on that as well later. And lastly, we will pursue acquisition targets in the regional aviation sector that fit with our business model and with our organization, and that we see as being able to provide mid-teen ROEs. Looking for a moment at the Falco Fund's growth plan and the capital under management, we're targeting continued high rates of growth here to achieve $3 billion in around 2020 or 2026. And as we've mentioned before, we are looking to co-invest in these funds. We see them as providing very strong returns, and historically, Falco has provided strong returns. And again, Jeremy will touch on this shortly. And lastly, a few comments on what adjacent businesses make sense for us to consider. As we look at acquisition opportunities, we're going to lean in heavily towards adjacencies that align really well with our business. Business to government opportunities that produce good free cash flow. Quality organizations with deep expertise and experience. Contracted-oriented businesses with long-term customer relationships. There are many adjacencies where our business model and talent fit well, including defense, pilot training, airline services, specialty aviation, aerial firefighting, parts, component repair and overhaul, and the further expansion of the asset management business. And the list goes on and on. There's lots of opportunities for us to consider. Now I'm going to leave it there, and I'm going to turn it back to Jolene. And once you've had an opportunity to hear from the team, I'll return in the end and provide a bit of a summary in the very end. Thank you.
Jazz is a sole provider of Air Canada Express service, operating more daily flights to more Canadian destinations than any other airline. We play an integral role in Air Canada's network.
For more than 30 years, Air Canada has worked with Jazz to provide regional services across Canada and to the United States. Over that time, Jazz has established a strong reputation, most importantly in the area of safety and customer service. Through Air Canada's CPA with Jazz, our two airlines essentially work as one. We have been and will continue to be strong partners with common objectives.
We are honored to be named one of Glassdoor's best places to work in Canada and recognized as a top employer for young people, best diversity employers, and one of Canada's safest employers.
We are leaders in pilot recruitment and training programs, having established a multitude of relationships with colleges and other institutions over the years. Our Jazz Aviation Pathways program is the premier pilot education and training program in Canada. And we have partnered with CAE to establish Jazz Approach, the first pilot creation program of its kind in the country.
Our commitment to maintaining a high professional standard and safe operating procedures can be seen in the professionalism of our flight crew. Jazz is a fantastic choice to have a career as a pilot. We have a great team that is united by professionalism and top-notch safety.
Okay, it's a great video. I just want to introduce to you Randolph de Gourier. Randolph de Gourier has a long history within the aviation and travel sector. He has 30 years industry experience in areas such as scheduling, revenue management, charter brokerage, and airline operations. So Randolph has been the president of Jazz since 2019, and I'd ask you to please welcome Randolph.
Thank you, Joanne, and good morning to everybody, and thank you for your time. I'd like to begin this morning by introducing our leadership team. As Colin mentioned, it is a strong team throughout the organization, and our team has 8 individuals. 7 of them have more than 30 or more years of experience in the business. Our leadership team supports 4,600 professionals in our Jazz operation, ranging from well-trained flight crews safely operating our fleet of regional aircraft, in-flight and airport staff providing exceptional customer service, maintenance engineers ensuring day-to-day reliability of our fleet, airframe maintenance engineers performing structural checks at our Jazz Technical Services overhaul facility in Halifax, leveraging our industry-leading productivity not just for our own aircraft, but also for third-party air customers. We have an experienced management team providing technical, safety, and administrative support, and all of this is monitored by our 24/7, 365 Systems Operation Control Center in Halifax. Jazz is the sole operator of Air Canada Express flights. Jazz and its previous airlines have a relationship with Air Canada that dates back 30 years. Jazz has been operating under a Capacity Purchase Agreement, or CPA, since 2006, and our current agreement is in effect till 2035. I'll take you through the CPA in more detail in a moment, but as you heard from Mike's video, we're an integral part of Air Canada's network, normally carrying about 20% of their passengers every day. This close integration of our networks and interdependence on each other is enhanced by the great relationships that exist between our 2 organizations. Jazz earns revenue 3 ways under the CPA, and these are 2022 actuals shown here. First, the fixed fee, which is a minimum level set by year to 2035, and I will provide more details in an upcoming slide. An aircraft leasing revenue on 48 aircraft that are leased into the CPA, which represents about 2/3 of our CPA revenue. There's also a performance incentive based on achieving certain operational targets. Our own fleet is relatively young at 6.6 years, and the debt related to these aircraft is matched to the lease term in the CPA. There's no currency risk as Air Canada pays us in USD for USD denominated debt. This route map changes a bit, but it provides a sense of the scale of our operation. We cover North America from St. John's to Sandspit and Haida Gwaii, and from Yellowknife to Houston. We are well positioned with crew and maintenance bases in Halifax, Montreal, Toronto, Calgary, and Vancouver. And with almost 50 trans-border routes, we play an integral role in Air Canada's Sixth Freedom strategy, connecting passengers from the 31 U.S. destinations we service to Air Canada's international destinations. There are many advantages that a regional carrier such as Jazz provides. We provide Air Canada with safe and efficient regional operations. We offer a less expensive source of labor and are focused on the specific regional aircraft types that we operate. It is difficult for a major airline to operate everything from 50 seats to wide-body aircraft. With crew and maintenance bases in each of Air Canada's hub airports, Jazz is able to respond quickly to their changing market needs, moving equipment and people around as necessary. And our size provides economies of scale with the ability to spread our overhead and infrastructure costs over the 600 flights we operate daily. We have a long history of working closely with our labor groups as we address challenges in the industry and are proud of our labor stability through our long-term labor agreements. In fact, our pilot agreement term is aligned with our CPA term and is extended out to 2035 and is likely one of the longest pilot agreements in the world. As I'm sure you are aware, there are currently some challenges in the industry related to pilot supply. Jazz has long been an innovative leader in pilot recruitment and training, having established relationships with 13 different schools and colleges, and this proactive approach has proved to be valuable for us. We're highly focused on pilot recruitment and training to support the pilot flow agreement we have with Air Canada that sees 60% of their pilots coming from Jazz. Currently, we are flying fewer hours than our usual capacity, as the impact of the flow has created some temporary pilot dislocation, and this is having a short-term impact on the Jazz operation. To be clear, we have no difficulty in recruiting pilots. Our reduced capacity is purely related to the length of time it takes to move pilots through the required training process. We continue to hire and train new first officers with a particular emphasis on the Jazz Aviation Pathways program and the recent launch of the Jazz Approach program with CAE and our sister company, Signet. Perhaps most importantly, we have a strong safety culture, and were recently recognized as one of Canada's safest employers. So how does the CPA work? CPA is a well-used business model common throughout North America and parts of Europe. Most U.S. major carriers have similar arrangements with U.S. regionals where they purchase 100% of the capacity from them. In these arrangements, the major carrier takes on all the commercial responsibility and the related risks and costs. The regional carrier is the operator and gets paid a fee to fly on behalf of the major carrier. The major carrier makes all the commercial decisions, and the regional airline simply operates to their needs. In doing so, the major carrier effectively makes the operating cost decisions. In most cases, the regional carrier also adopts the major carrier's brand. A CPA really does provide predictable and stable earnings and cash flow. In keeping with the CPA model I just mentioned, Jazz is reimbursed for substantially all of our costs of operation. Pass-through costs, like airport and navigation fees, are fully paid by Air Canada with no impact to our earnings. Certain costs like fuel do not even hit our books, with the invoices going directly to Air Canada. Our controllable costs are subject to an annual rate-setting exercise based on Air Canada's requirements, and Air Canada pays us monthly based on these rates. The actual controllable costs will usually vary, so at the end of the year, we reconcile the actual costs to what has been paid to us, such that Jazz controllable cost earnings will only fluctuate by a maximum of plus or minus $2 million in a calendar year. You will often hear us refer to that as the controllable cost guardrail. Maintenance capital expenditures are covered as a depreciation charge and are fully reimbursed. Administrative costs in 2022 represented less than 9% of our controllable costs. These costs are also reimbursed to us on a predetermined graduated level that is tied to our flying levels. We have consistently performed under these administrative caps and expect that to continue. While this was under 9% of overall controllable costs in 2022, we expect that percentage will reduce as flying levels return to pre-pandemic levels. As I mentioned earlier, one of the primary ways that Jazz earns is through the fixed fee. The fixed fee does not vary with flying levels. It does not increase the more flights we operate, nor does it decrease with reduced flying. This slide is a good depiction of how the CPA provides earning stability and predictability. The black bar represents a fixed fee in each of the years 2019 through to 2022, and the red line represents the number of block hours that we operated in each of those years. As you can see, it stayed relatively consistent throughout the pandemic, where we were operating at levels well below our capacity. In 2020, we were at 36% of 2019 levels, 42% in 21, and this past year at 77% of 2019. In total, the CPA provides for $1.4 billion in total contracted revenue to 2035. Here is a breakdown of the contracted value between the fixed fee and the aircraft leasing revenue for the periods of 2023 to 2025, and also for the following 10-year period to 2035. For aircraft leasing, the revenue figures do assume some rollover existing leases after expiry, the details of which can be found in the appendix that we loaded today. To provide a sense of the cash flow related to the lease revenue, this chart on the right-hand side shows you the revenue charted against the debt servicing costs, both principal and interest, on the amortizing debt against the aircraft. There is substantial cash flow being generated by the net lease revenue, with $97 million for 2023 to 2025, and a further $120 million for the 2026 to 2035 period. In closing, some key takeaways for Jazz is that we are a leading regional operator, we have significant contracted revenue, and we have minimal downside risk. Thank you.
Falco has a deep heritage in the aerospace world, with its office being based on the site of the former de Havilland factory, where the first commercial jet aircraft, the Comet, was built. We have one of the most experienced teams in our market and have operated successfully through many cycles. We have a strong track record of raising debt and equity capital and have always delivered for our funding partners. Our deep trading expertise allows us to opportunistically explore aircraft sales to maximize asset returns.
There's a large and recurring demand for regional aircraft. The growth trajectory is expected to be strong, with a projected demand of some 11,000 aircraft worth over $600 billion through to 2040. Falco is the largest asset manager in the world focused solely on investing in regional aircraft. We have a team of over 80 people, largely based in London and Dublin. We have a 30-year track record of transacting on a worldwide basis and through multiple aviation cycles. We manage a high-quality portfolio of around 240 aircraft with a value of over $2.7 billion. These are on lease to over 40 airlines around the world. Falco is very well placed to capitalise on a significant market opportunity.
We're relentlessly focused on building long-lasting partner relationships, being responsive and finding solutions for our customers, thus ensuring the stability of our business.
We have deep and established relationships with a multitude of stakeholders. These include airline customers, equipment manufacturers, other leasing companies, banks, and equity investors. Our airline customers would say that we understand their businesses, that we're responsive to their needs, and that we have demonstrable execution capability. We have huge support from our providers of debt and equity capital, as we have consistently delivered and met their expectations. These long-lasting and mutually beneficial relationships are the bedrock of our business.
Okay, so I know everyone's super excited to hear from our next speaker, but let me tell you a little bit about Jeremy before I call him to the stage. So Jeremy joined British Aerospace in 1993 to lead its commercial aerospace financing initiatives. And while at BAE, Jeremy was responsible for all aspects of corporate finance within the commercial aerospace sector. After leaving BAE in the late 90s, he founded Orbis Capital, a corporate and structured financing company specializing in aircraft and other asset-backed transactions. Jeremy led the buy-in of BAE's asset management business in 2011, which led to the formation of Falco. So please welcome Jeremy Barnes, CEO of Falco.
Morning all. It looks as though I was having a bad day when we did the video, so I hope this goes a bit better. The video can replace all of these slides, but the bad news is I've got about 15, 20 slides to run through with you. Anyway, lovely to see you all. Nice to be back in Toronto. Got the 15 or so slides, 20 some minutes, but there are two key themes that I want you to focus on, and I will be asking questions. I warned somebody in the audience a bit earlier on that there will be questions from me rather than the other way around. The first theme is pretty straightforward. The opportunity set in my arena today is like something I've never seen in the past 30 years. So if you looked at the way my competitive landscape has changed over that period of time, it is quite remarkable. Second theme is, do we have the right tools, platform, experience, access to capital to take advantage of that opportunity? And quite clearly, obviously I wouldn't be standing here otherwise, I very firmly of the view that we absolutely do.
So skating on to the next slide. A few big numbers that just scope out the size of my business. We have over 200 airplanes with 44 lessees. That makes us, as I think Mark said in the video, Mark's here somewhere, that makes us the largest pure-play regional aircraft asset manager lessor in the world. That was not true 3 years ago, and that's part of the opportunity set. We have about $2.3 billion worth of value. Our airplane average age is just under 9 years, which actually makes it on the young side. So if you look at the in-service fleet today, it's probably 12 or 13 years old. So we have a very, very good fleet from that standpoint. And our average lease term is about 6 years. Again, another healthy metric. One thing we might want to reflect on as we sit here today, bearing in mind we did the merger about a year ago-ish, is if you look at the combination of the two fleets, my fleet and the Chorus fleet, they couldn't be in a better fit. So what we spent in my Falco world, spent our time doing, was largely buying regional jets, and they were used. By contrast, of course, the guys at Chorus were spending their time looking at new airplanes and largely turboprops. So the combination of the two is very, very compelling. Now, this book of business is actually managed by some 80-plus people. We have a few people in Singapore, we have 20-some people in Dublin, and then the balance of the team is in Hatfield, and as we said, it has some very deep heritage. It is the home of the commercial airline. So the seven people on this page do all the work. I'm the lucky guy. I have aged a bit, haven't I? I'm the lucky guy who actually just nudges the tiller every now and then. This page actually really doesn't do these people justice. Partly the photos, partly because of their depth of experience. We have one of, if not, the most experienced team in this space, bar none. 5 of us, the so-called Falco 5, which actually does sound like some rowdy gang from the Wild West, but the Falco 5 have actually worked together since the early 90s. So we've been through pretty much every cycle, every scenario, every side of the table in our industry. The wealth of experience here stood us in incredibly good stead during the pandemic. What the pandemic did, it weeded out those people who are real practitioners versus those people who are essentially theoreticians. And the evidence of that, which you'll see a bit later on, is we were one of the few people through the pandemic who were able to get an aircraft ABS deal done. We did an aircraft ABS deal in 2021. It's proven to be one of the most successful aircraft ABS deals out there. No downgrade, no nothing. Sitting below these 7, 8 some people are a massively comprehensive team. We have a lot of internal capability that most other people would actually export, subcontract. What's the benefit of that, other than its overhead, you might say? Well, the answer is it means we can move very quickly on transactions, or indeed, better still, we can do massively complex transactions that others wouldn't even take a crack at. We have 2 very good examples of that. One would be, for example, the Falco team have completed, executed the largest single trade in our space. We did a $1 billion deal back in 18 going on 19 with Avalon. Largest single trade. The second one is in May, June of 2020, we were approached by one of the biggest major airlines in the US. At that time, because everybody was scrambling for liquidity, everybody wanted to do sale and leaseback deals and all that sort of good things. They offered us a super deal, like a deal like you would never see again from this airline. However, we had to trade within 3 weeks, which is probably doesn't mean a lot to you guys, but actually putting together a transaction like that in our world in 3 weeks is quite a remarkable achievement. We closed it, and better still, we actually raised the debt within that 3-week period again. What does that mean? It was we have a super trade, and we are one of the favored few of this very major airline. Scooting on. A few big numbers. I'm not going to go through these. These are numbers that you guys will have observed from our reporting. But this presentation is all about the future. It's all about the opportunity. So this goes back to the heritage. I think Colin referenced, we go all the way back to 1993. I guess you can tell that by my gray hair. But if you go all the way to the left-hand side here, my heritage is back to 1993. 1993, I got hired by British Aerospace, who at that time was one of the largest manufacturers of regional aircraft in the world. However, much like most of their competitors, they had largely fueled their revenues, their sales, by offering billions and billions and billions of dollars of vendor finance. So by the time you get to 91, 92, they had about 650 airplanes in a portfolio. Second largest aircraft leasing company in the world that nobody had ever heard of, until they took a £1.1 billion provision, prompted by the fact we obviously had the Gulf War, spike in fuel prices, major airlines, some of which you guys probably would never even remember, people like Eastern and Braniff and Pan Am all filed. We had 650 airplanes, about 20% of that got parked pretty much overnight. There was no infrastructure to manage the risk, there was no risk pricing, there were no tools and techniques to manage the portfolio properly. As an ex-banker who knew absolutely nothing about airplanes, I got hired to create a framework to manage the risk. In part, the solution was I didn't know much, so I hired people who knew a lot more than me, so hence the Falco 5, which actually was probably like the Falco 10 at that time, but nevertheless, 5 of us were part of that team. Through the 90s, we cleared up the biggest pile of toxic waste you ever did see. We restructured airlines down in the US, in South Africa, Australia. We sold an airline, which is obviously very dear to some folks in Halifax. We sold Air Atlantic. Forced to sell it by the Canadian government, which is a bit disappointing. We repossessed airplanes and so on and so forth. Our DNA today stems all the way back to there. Many of the tools and techniques and how we think about our business goes all the way back to the 90s, where we're cleaning up. We learned very quickly how not to do it, but we also knew the key ingredients to be a successful leasing company. You roll that forward, we effectively put a ceiling, a lid on that risk in 1998. We did what would be called today a synthetic securitization. We took out a $3.4 billion insurance policy, effectively, and that basically guaranteed the cash flow of the remaining portfolio for 13 years. Having done our job, we decided we'd move on and we set up our own business, and that's when the Falco 5 was really born, although we won't call it Falco then. We got the opportunity to buy the very same business back in 2010, 2011. I was approached by BAE. Managed to raise a few $100 million from our friends at Fortress, and away we went. And that was a truly successful marriage as between us and Fortress. And we did some exciting things on the way. 2 of those were, A, we raised our first fund in 2015, which is a $450 million fund. We raised our second fund in 2019. What really drove the desire, the need for the second fund is, as I referenced before, we got the opportunity to buy $1 billion worth of airplanes from Avalon. We didn't have enough dry powder in the first fund, so necessarily we went on and raised the second fund. Cantering on a bit further, other couple of landmarks worth referencing. Already touched on the aircraft ABS deal. We're one of the few people that were able to do it at the back of the pandemic. And again, I think that's a pure testament to the quality of the platform. What the pandemic did, it weeded out those people who were great with a spreadsheet versus those people who really knew how to run a portfolio properly. We then obviously had the fun of the M&A process and ultimately the success of our merger with Chorus. And then last but not least, kind of reasonably latest news anyway, we refinanced our second fund about 6 or 8 weeks ago. Interesting process, if nothing else, because we had a fairly competitive process amongst 3 of the most significant aerospace banks in the world. So our following, both from a debt and equity standpoint, is truly immense. Keep going. There we go. So today, sitting before us is one of the most compelling opportunities, business opportunities I've ever seen in my 30, 40-year career. If you look at it, we've had a major, major, major change in our landscape. If I'd have been here in 2020 and I'd forecast where we're sitting today with respect to our market landscape, you'd probably be putting out sell notices on the basis he's an absolute raving lunatic. It's never going to happen. But it has happened, right? So it is somewhat ours to exploit. The pool that we go fishing in, our target market, is about 9,000 odd airplanes. Embraer, as Mark said in the video, are forecasting demand for 10,000 odd new airplanes through 2040, worth about 650 billion. Interestingly enough, the lion's share of those, unlike, say, the narrow-body market, the lion's share of that demand comes from replacement rather than speculative growth. Speculative growth is where it all gets a bit exciting when you have a down cycle. Ours is all about replacement. We'll talk a bit more about that further on. If you look at it similarly, helpfully, the supply of capital into our space has massively shrunk over the last 3 years. So our two biggest competitors, pre-COVID, NAC and GCAS, have both gone in different directions for different reasons. Nothing to do with the underlying performance of the regional aircraft space. So in the case of NAC, it was a change of management. In the case of GCAS, it was the sale of GCAS to AerCap. AerCap as an institution has no real interest in regional airplanes. If you reflect on it a bit more, the timing of the merger between Chorus and Falco could not have been better. So the critical mass we have today enables us to really go after that opportunity. We're fabulously well placed to do that. I think I just jumped a slide, but whatever. Anyway, if you do one thing, focus on this slide. I don't care about the other 15, 16 slides. This is it, right? This is where all the fun is. So that slide, if you rolled it back 3, 4 years, you'd have NAC with, say, 500 airplanes. AerCap wouldn't be there at all, but you'd have GCAS with something like 200 airplanes. Falco and Chorus would probably be sitting there with, we'd have about 130. Chorus would have about 70. Now look where it sits today. So our friends at NAC, they obviously had some trials and tribulations, but critically, they had a change of management. So when AerCap took GCAS over, funnily enough, the GCAS team didn't survive. The GCAS team then found themselves at NAC. Their bread and butter is narrow-bodied aircraft leasing. So their stated strategy is to focus on that. Ditto AerCap, no real interest in regional airplanes. So they won't be investing in this space, but probably more particularly, they will be divesting of those assets, because particularly in the case of NAC, they will recycle capital to diversify themselves into their narrow-bodied arena. So if you look at it, we're the single largest pure-play player, too many players there, but whatever, in this space. Right? To give you some sense of quantum here, if you look at 16 through 19, between ourselves, as Falco then was, Chorus and NAC, we invested $5 to $6 billion in airplanes. And today, we're sort of the only guy at the bar. So what does that really mean? It means a bunch of different things. So our ability to deploy capital on a consistent basis has become a lot easier. We'll have pricing stability. You could lay case to the fact that we're much more influential on price than we were before, so we might be more of a price maker rather than a price taker. Any deal of size in this space will necessarily have to come to us in some shape or form. Very few others in our space can write meaningful checks. So literally, you could not script this. Not short of opportunities. So if we just look at 22 just by itself, right? So we saw 52 odd deals during the course of the year, about $3 billion worth of transactions, 300 some airplanes. On average, we'll see $2 to $3 billion worth of deals per annum. Our mantra, unlike many others in this space, our space, is not to just get to scale for scale's sake. It's all about price, it's about the quality of the credit, it's all about returns. It's all about being highly selective. So as you see, we actually get rid of a whole, we probably have a strike rate of about 10% of what we see. But that's all because we want to be very selective and to be brave enough to walk away from deals that others are doing. I put this slide up, I think as Colin referenced a bit earlier on, we might be somewhat of an unusual beast in our arena, in as much as we're very active in terms of how we manage the portfolio. So we're not there to queue up assets for fun. We're there to find value, add value where we can, and then release value. So in our case, since 2011, we bought thick end of 400 airplanes. As Colin said earlier on, we've sold about 185. And we've sold assets where they are on lease to super credits, but what we're really focused on is the return. Leased airplanes, 104-odd airplanes, so airplanes that have come off their primary lease and they're still on our books, we will lease them on. We've done lease extensions on a lot of airplanes, and interestingly enough, that is becoming increasingly prevalent over the last 2 years. So the urban myth that the world has ended for regional airplanes is a total load of nonsense, candidly. We parted out some airplanes, and a couple more recently with our friends at Voyager. What's not on this is how we've repurposed airplanes. So, good example, we've converted ATRs to freighters. And for those of you who have an eagle eye in the video, we've actually converted some airplanes into aerial firefighting machines. So, lurking over our shoulders in the video, you'll see an RJ-85 that's Conair airplanes, Canadian business. We converted 12, 13, 14 of those airplanes to aerial firefighting planes. The genesis of that is squeezing that last increment of value out of older airplanes. You need to think slightly differently. That's how you do it. Our history, our DNA, which we plotted before, is all about that. How do you maximize value out of airplanes? So we put this graph up. This graph came from Cirium Ascend. Probably doesn't mean a lot to much of you, but they are one of the most accredited aircraft appraisers, consulting firms in the world. Again, back to the old urban myths. The urban myth says, well, regional airplanes aren't much good. They're on lease to rubbish airlines. And by definition, everybody piles into the narrow-body space because there's supposed to be more money to be made there. Total nonsense. So if you look at this graph, this is not a Jeremy Barnes, scratch some numbers out on a spreadsheet and see what you can come up with. These aren't my numbers. These are Cirium numbers. But interestingly, if you look at it, you'll see where the benchmark is, which is the Ascend Leasing Index, which probably gets to about 1.5 through 2021. If you look at TrueNord, who probably are now our nearest competitor, independent regional, all they do is just regional aircraft, they similarly have outperformed everybody else. Helpfully, the light blue line on the top is Falco, where if you look at it, we just to get above about 3x in 2021. If you get your HP12C out, assuming they still exist, then that sort of comes out to about a 16% compound return. So back to Colin's point about what sort of returns can we make out of this business? We know what we can make, and actually it's better than that. But even Cirium, independent third party, says, well, our best guess is Jeremy and his merry men are making about 16% compound. So our lifeblood is capital. Yeah, we are capital hungry. Part of that is debt, part of that is equity. So we touched on this before. We raised, at least through 2015, about $1 billion worth of equity. We raised a few $100 million before that, because obviously we did our acquisition of our British aerospace portfolio back in 10-11. In both of those cases, we exceeded our expectations, exceeded our targets. Having equity is kind of interesting, right? But if you haven't got the debt, it's a pretty worthless exercise. So if you kind of gross that up by about 65%, so typically we target 60-65% leverage, then in aggregate, we probably raised about $3 billion worth of capital, debt and equity, since 2015. So we have a very good track record and a very good following in both the debt and the equity markets, and evidenced by, again, on the debt side, by our ABS deal, and more recently, in a tough market, getting away a debt deal. Fund 3, I know you probably want all sorts of questions about that, and the short answer is it's in progress, right? So we feel very good about it all. We have a very good following. The key to success in our world is getting re-ups from our existing LPs. That process is in train, right? And obviously we'll have more news for you at the end of Q2. So this is what it takes. For those of you who haven't done it, I'm not sure I'd recommend it to you, but this is what it takes to go raise a fund. So I'm not going to go around each of these little squares. We use Evercore as our placement agent. This is something they did for us after we concluded our second fund. You can see the people who get wealthy out of this are the lawyers. 60 drafts of the PPM. Christ knows what it is per turn, right? But either way, it's a lot of money. 174 meetings, 1,600 due diligence questions. Bear in mind, each of those ones has to be verified. So again, good for the lawyers, eh, Dennis? We had 20 on-sites. Our kill rate's not bad, a 65% kill rate. So once we drag somebody back to Hatfield, we seem to do pretty well. The one I really like, however, is the 90 new LPs. So we transformed Fund 1, Fund 2. Fund 1 was much more family offices, pension funds, European-based. Fund 2 was all about the US. It's all about big US state pension funds. And that generally is big, sticky money. So once you've got, for a better word, got your nose in the trough, it's a good place to be. So, but it's quite a task battling your way through a fund. Fund 3 summary. Again, we'll try and make this, I tried to simplify this as best I can. So, funnily enough, it's going to be called Fund 3. Our target returns are mid-teens IRR and 1.5 to 2x gross. We would expect, it's a 10-year fund, which typically has 2 one-year extension options. And we have a 5-year investment period. Our fee structure is that we get paid on committed capital, but that's only for the first 5 years. After that, you get paid on capital that actually has been deployed. If you look at what it means in terms of, well, how many airplanes you've got to go to spend this sort of amount of money? And bear in mind, we're targeting a minimum of 500 million. Only about 100 to 120 airplanes. Now, if you were listening a bit earlier on, we're fishing in a pool of 9,000 aircraft that's growing. We're fishing in a pool where two of the biggest lessors historically in our space are going to be trading assets. So we feel very, very comfortable about deploying Fund 3. How do we make money? It's always a good thing. How do we make money as a GP? And so make it in a bunch of different work streams or different cash flow streams. We just work from the bottom up. The bottom one's the easiest one. So we get management fees. So as I said before, we get management fees based on committed capital for that 5-year period. But then once the capital runs off, you get paid relative to the fee, the capital that's remaining in the fund. As a GP, you get it in 2 different ways. So we put our money in the fund alongside the LPs, third-party LPs. We get a commensurate return. In this case, in this worked example, it's entirely hypothetical. The assumption is we'll generate about a 1.5x. That's not difficult. So 25 goes to whatever it is, 37.5. That's our return on our initial investment. Then what happens is there's the performance-related return. And so the standard metric in our space anyway is that we get 20% of the excess over a preferred return. It's typically 20% excess 8. So in our case, just running this fairly noddy model, the total carry available is 55 million. Carry is generally shared between the GP, effectively, and the management team. Bear in mind, the LPs want to make sure that the management team that's doing all this stuff is very, very focused on actually delivering. So in this case, it's 50-50 split. So if you take the share of the carry plus the GP return, the money multiple on your initial investment of 25 million bucks here is about 2.6x. If you wanted to do a rudimentary IRR on that, not that you could because you don't know what the profile looks like, but if you were to run the one I ran, it's a high teens IRR. So as a GP, this is a very lucrative investment. So key takeaways are 2 themes. One, the opportunity before us is probably once in a lifetime. I have never seen anything like this in 30, 40 years, right? Ours to exploit. The question is whether or not we have the wherewithal, people, experience, access to capital, market position to be able to exploit it. I hope you all go away with the view that we do. Thank you.
Voyager operates within many unique segments in the regional aviation market, performing special mission flying in remote areas around the world, along with small charter and cargo operations. We are focused on growth. We recently expanded our capabilities to move into the defense sector, providing in-service support for manned airborne surveillance. Defense is a global market with attractive growth opportunities. We continue to expand our used aircraft parts sales with capabilities across multiple regional aircraft types. This is a growing sector and delivers strong margins.
Our team offers a full suite of regional aviation services, including contract flying, leasing, aircraft modifications, and end-of-life disassembly and parts sales. Our customers come to us and they stay with us because we are experts in our field and we deliver innovative solutions to meet their specific needs.
Some of our customer relationships go back decades, and these long-lasting and mutually beneficial partnerships help ensure the stability of our business.
From salvaging used serviceable materials to the repair, overhaul, and certifying of components in-house to utilizing our supply chain and strategic partnerships in the marketplace.
We have a dedicated and highly trained team ranging from technical experts to financial specialists and everything in between. By creating a welcoming and safe space, we find new opportunities that help all of us grow.
Welcome back, everyone. I think you would have seen in the video there Corey Cousineau, who is the president of Voyager, and Corey had been planning to be here today, but unfortunately, due to an unexpected personal matter, he's not able to join us. So we do have a substitute, and I think it demonstrates the strength and the depth of the team to be able to have a stand-in here. Gary Gilbert is Voyager's Vice President of the Parts Division, which is known as AvParts, and he'll be speaking today on behalf of Voyager. Gary has over 25 years of aviation experience and sales and customer experience. And many of those years have been in the areas of material management, logistics, part sales, and planning. So prior to joining Voyager, Gary led the Power by the Hour program at de Havilland, formerly Bombardier, as many of you will recall. So please join me to welcome Gary to the stage.
Thank you all. Thank you, Jolene. Yeah, unfortunately, Corey wasn't able to attend today, so you have me as a stand-in. I'm the lesser-known, shorter Gary. You'll hear from the other Gary here shortly, so bear with me as we take you through Voyager. Let me start off with our exceptional executive team, having significant experience in the regional aviation market. These key individuals represent an excellent balance of organizational veterans, along with some newer to the organization leaders, focused on our primary growth areas. Voyager is a specialty regional aircraft aviation company. We are a global company, both in our extensive customer base and our areas of operation. Our operations are headquartered at our 200,000 square foot facility in North Bay, Ontario. And that facility provides an excellent home for our regional aircraft maintenance activities and warehousing. We operate in 4 primary sectors: parts sales, supported by our aircraft disassembly and parts certification capabilities; government and defense programs; specialty maintenance, repair, and overhaul and design engineering; and finally, specialty contract flying with aircraft deployed worldwide. These business units can service customers independently, but they are often leveraged on products that provide customers with a full suite of regional aviation products. Some of our largest customer successes are a result of combining these services all under one roof. 2022 was a high watermark for Voyager in terms of revenue at $104 million. This represented a year-over-year revenue growth of approximately 20%. In keeping with the Chorus business model, much of Voyager's revenue is contracted. In 2022, 71% of our revenue was associated to contracted activities. The continuation of many of these contracts and new contracts acquired early this year provide us with an existing contracted revenue base of $135 million through 2025. With aircraft part sales being a large component of Voyager's growth, we have been very active in aircraft part outs. We have disassembled 36 total aircraft since 2018 to feed our aircraft part sales business. 16 of these 36 aircraft were acquired either from Jazz or Falco. This fact speaks to Chorus's ability to maximize value from our regional aircraft assets, making use of the entire aircraft lifecycle. Customers. Customers are certainly the lifeblood of our organization, and we are proud to display many of our key current and recent customers here. For all of these organizations, we have had multi-year contracted activities involving specialty aviation, in some cases exceeding 20 years of continual service. For many of these customers, we have combined the services of our 4 primary business sectors to provide an overall product. This has included highly modified aircraft, specialty contract flight operations, and ongoing parts and maintenance support. Voyager is currently engaged in a significant growth plan. This growth is facilitated through a solid core of contracted services through all of our business units. Part sales growth will continue to be a significant driver through 2025 and beyond. The used part sales market is growing at a 2% compound annual growth rate. Enablers for this include difficulties with OEM support. Given global supply chain issues, the lead times from OEMs is very, very excessive. Aircraft are remaining in service with operators for longer periods, fueling the need for additional part support. Airlines and MROs are also looking to spend less money on parts and moving towards more used parts to drive cost efficiencies. Voyager is taking advantage of these factors. We're solidifying its existing regional aircraft product offers, which has been typically the Dash 8 and the CRJ 200 market, with additional inventory and expansion of our current market share. We are also expanding our regional platforms to most notably the ATR and Embraer fleet, and we're presently engaged in inventory acquisitions of ATR and Embraer through part-out activities. Defense. Defense is another growth priority for Voyager, particularly the airborne intelligence, surveillance, and reconnaissance, or ISR, market, where Voyager has existing expertise. The market includes the use of missionized aircraft to protect, monitor, rescue, and gather for military and civil purposes. As Colin outlined, regional platforms are often employed for these missions, and service segments including leasing, modification, operations, and in-service support. These are all significant strengths for Voyager. This ISR market is growing by a 6% compound annual growth rate to $7.3 billion US in 2025. North America accounts for the largest share of the market at about 52% and is expected to lead future growth. Growth in ISR is supported by defense budgets around the world growing at higher rates, an enhanced need for sovereign protection of coastal areas, heightened migration flow, and a continuing desire or need for defense departments to engage contractors for key activities. A primed case in point is the Canada Manned Airborne ISR program recently awarding to the team consisting of Voyager, General Dynamics, under the moniker of Team Certus. This is an 8-year contract in which Team Certus will provide all of the maintenance and in-service support for 3 ISR aircraft being acquired by Canada. These types of industry defense partnerships will continue to be more commonplace. Voyager is a well-suited partner with Jazz and Falco on many opportunities to extract the maximum value of our aircraft assets. There are many avenues for these opportunities, including facilitating the transfer of aircraft between customers leading to modification and reconfiguration services, providing parts for the in-service aircraft, and providing near end-of-life assets a suitable off-ramp through sale, lease, or eventual end-of-life disassembly. So I believe Voyager is in a fantastic position to continue to be a leader in the specialty aviation in Canada. Our breadth and depth of services and our ability to leverage those services is unmatched. We are well suited to continue to significantly grow the operation, and our ability to manage the end-of-life process in the Chorus family ensures asset value is maximized. Thank you.
Okay, get your calculators out because financial is up next. So Gary Osborne, 2, you're seeing a theme here. Gary Osborne, 2, has 30 years experience in the aviation sector, most of that being in regional aviation. Gary joined Chorus in 2006, and he's held various senior roles within the company before becoming the CFO in 2019. I'm going to turn it over to Gary.
Thank you everybody, and for coming here today. First off, I'd like to start with a look back at 2022. It was quite the transformational year for Chorus. We acquired Falco in May, and since then, we've certainly improved our financial metrics, or all significant financial metrics. In that first 8 months of owning Falco, we've seen significant dividends paid from them. We've had net proceeds on asset sales after debt repayments of about $152 million from them, and an adjusted EBT of $55 million. This cash produced by Falco allowed for the early repayment of our 6% debentures, which further delevered and de-risked our company. Our leverage at the end of 2022 stands at 4.4, down from 5.4 at the end of 2021, and just as importantly, down from 6.4 at the end of Q2 2022, just after we acquired Falco. We expect to continue the deleveraging based on our expected free cash flows, including our asset sales, our continued amortization of aircraft debt, and the pay down of our unsecured credit facility. So overall, our 2022 results were strong, and the deleveraging positions us well for 2023 and beyond. Certainly when we look at our stock price, we feel it's undervalued. It's undervalued versus the book value, and it's undervalued versus our intrinsic value. And I'll go into these comparisons a bit later. And while I think every CFO these days can say their stock is undervalued, I think we have a stronger case than most. Factors that support that conclusion include $2.6 billion in future contracted cash flows, including $1.4 billion from our Air Canada CPA agreement with fixed fees and aircraft leasing under the CPA, another $1.1 million from Falco with future contracted aircraft leases, and another $100 million from Voyager. It provides a stable and predictable future cash flow base. We also have net assets of around $1.3 billion. So when you deduct the debt, we have $1.3 billion of assets backing up our stock price. These are significant given Chorus's market cap is just around $600 million today. Combine this with our business has changed. We have lower leverage, and we have a commitment to future leverage reductions. And this means our risk profile is and will continue to improve. The business transformation is expected to unlock embedded equity value in our aircraft assets and generate free cash flow to increase our shareholder returns. When you combine all these factors, we see Chorus as being undervalued and the embedded cash flows providing additional value. So what do we mean by Chorus is undervalued? Well, we continue to see Chorus trade in the $3.30 range based on the latest VWAP, and it's a bit lower than that today. Currently, it's an 18% discount to our $4 book value per share, which is fully supported by our assets alone. While we don't believe book value is an appropriate trading value for Chorus, it does, in our opinion, represent the absolute floor for the stock. We believe a more appropriate value is our intrinsic value, which we place around $5.50 a share. Intrinsic value, which I'll go into again later, accounts for the valuations of our various business lines. We believe it better represents the value of the portfolio of regional aviation companies Chorus has. In addition, our business transformation is expected to unlock additional shareholder value as we monetize those assets. We believe our planned business transformation could add another $1 to $2 a share, which I'll walk you through in the rationale in a moment. I'd like to talk quickly about our free cash flows for a moment. We generated over $1 billion in free cash flows since 2019, and the peak of $371 in 2022, which includes about $152 million of those net asset sales I talked about earlier. This free cash flow history exemplifies our ability to generate cash from our business operations. It demonstrates Falco's trading ability. This trading ability will be critical to fuel our business transformation moving ahead, and Falco is well positioned to do this. Asset sales are difficult to predict in timing and difficult to predict in quantum at various points in time. And with that, we did disclose in our Q2 2022 financial statements that we expect our free cash flow for 2023 to be somewhere between $260 and $330 million. This includes $25 to $50 million in net asset sales, or net proceeds on assets. Overall, we see our history of strong free cash flows and the strength of our current operations providing a strong base for our expected business transformation. So let's talk about how much value we have for the business transformation embedded in our aircraft assets at Falco. If we look at our year-ending 2022 financial results, we see an opportunity to monetize and use net proceeds from our aircraft assets of about $700 million US. The value simply takes the net book value of our owned assets at Falco and reduces it by the debt and minority interest. This is a significant value to fuel our business transformation and propel the business forward. When you look at our most recent trades at Falco, they were all at a slight premium to book value, about 3%. While this is not a guarantee of future success, it does provide a background as to why we believe the $700 million US opportunity to monetize assets is real. We recognize sales will take time, they'll be lumpy, and they will be dependent on market conditions. In the absence of a significant monetization event, and as disclosed in our Q2 2022 financial results, in the Outlook section, you can expect cash or sales between 50 and 100 million, generating somewhere between 25 and 50 million US this upcoming year. A question we get asked a lot, and Jeremy alluded to earlier, was where do you see Falco going, and how do the economics work? The Falco acquisition allows for less exposure for the Chorus balance sheet through the growth of capital and assets under management. These funds allow for deeper and more timely access to capital for Falco to pursue aircraft regional leases. Committed capital is expected to grow from around $1 billion US today to somewhere around the $3 billion US range in the 2026-2027 timeframe, which puts assets under management for the funds somewhere in the $5 to $7 billion US range. In the longer run, we don't see a significant amount of assets on our balance sheet related to aircraft leasing, but it will take some time to grow the funds and to monetize the embedded aircraft value. So when you look at the economics of funds, which Jeremy outlined earlier, you'll see that there's about, in the management fees, somewhere between 1 and 1.5% of committed capital, as Jeremy talked about, first 5 years based on committed capital and then the capital deployed. That's consistent with what we've seen to date. The funds will net an IRR of about 8 to 12%. Chorus, as an investor, will net that same amount along with all the other investors. So part of our partnership with the LP investors. As Jeremy mentioned earlier, we plan on investing up to 15% in the funds. In expressing carry incentives, in Jeremy's example, we could earn up to 5% of the committed capital value being earned through the funds. All this adds up to a mid-teens IRR for Chorus, and we see this as a stronger quality of earnings than today, given the returns are comparable to on-balance sheet leasing, but without the direct exposure and risk to the Chorus balance sheet. The next few slides, I want to talk a little bit about the company valuation, including our selected peer group. As I mentioned earlier, we don't believe our stock price reflects the value of Chorus and where we're going. With that, I'm first going to look at the book value per common share as at the end of December 22. While we do not believe it's a fair representation of value, as I mentioned earlier, it does provide a floor, given it's supported by the net assets of the company of $4. We also have, in addition, $2.6 billion in contracted revenues backed by strong customers, including Air Canada. So when you look at the current trading price at $3.30, it translates into roughly into a 0.8 price to book, which when you compare it to our peers, which we've loaded for you in the appendices, is of 2.3, shows a significant disconnect between our stock price and others. So as I look to explain where we see the Chorus intrinsic value, I think it's important to talk a little bit about our peers and where we compare to them, as this will form the basis of the intrinsic value calculation I'll go through in a moment. We see each of our operating businesses as being distinct. As such, we looked at peers for our companies that had similar market characteristics. While no comparison is perfect, we feel it is a reasonable comparison group. And so for Falco, we used a selection of asset managers and leasing companies. And for Jazz and Voyager, we used a selection of small to mid-cap industrials. You'll notice on the screen, for Falco, we're using a price-earnings ratio, which is consistent where a lot of the market, including a lot of our analysts, value the business. This allows for the capture of the expected earnings shift over time to asset management and allows the market to adjust the multiples as we execute on that strategy. For Jazz and Voyager, we used an enterprise value to EBITDA multiple, which is common for these industrial companies. The result is we see a comparative group of about, for Falco, being in the 12 times range. We also looked at the enterprise value to EBITDA for Jazz and Voyager in the 7.7 range. As part of this exercise, and with the debt levels we'll go through in a bit as far as the benchmarking, we looked at a Chorus peer group, which came in at a median of about 3.1. These ranges, which are detailed in our appendices, lay the groundwork for our intrinsic value calculations in a moment and set the stage for establishing a leverage target. We feel these ranges are relevant given the peer group, given our $2.6 billion in future contracted cash flows, and our deleveraging has reduced the risk and changed our company profile. So now let's look at the intrinsic value of Chorus that we place. We believe a sum of the parts methodology for Chorus is an appropriate measure given the different business characteristics. For this evaluation, we used peer companies and multiples described earlier and applied it to the earnings of each entity. These multiples are slightly lower than the ones I showed on the previous slide, but in line with recent 2022 values, which we have outlined in the appendices. We, of course, deduct corporate financings, including our debt and preferred equity, to arrive at this share price. So when you bring it all together, we have an intrinsic value of $5.50 for our common shareholders. And if you rolled it all up, That's an enterprise value to adjusted EBITDA of just under 7 and about 11.5 for price earnings. This intrinsic value is again backed by future cash flows of $2.6 billion, $1.4 billion coming from Jazz, $1.1 billion from Falco, and another $0.1 from Voyager, assets net of debt of approximately $1.3 billion, and the accomplishment of significant deleveraging this year and a published target that shows our commitment to managing risk. We've also demonstrated progress on our return of equity this year at 14.6 and published a target that shows focus on creating shareholder value moving ahead. In summary, we have an intrinsic value of $550 that is backed by market multiples, strong free cash flows, assets, and earnings, along with a commitment to de-risk and de-lever our balance sheet. The next number of slides talk about our capital allocation and the impact of the business transformation. We certainly saw a significant deleveraging this year thanks to an improvement in earnings and free cash flow driven by asset sales from our Falco acquisition. As noted earlier, we delevered from 4 to 4.4 this year, from 5.4 last year, and 6.4 in Q2 of 2022, just after our Falco acquisition. We see this deleveraging continuing and leading to reduced risk and a better quality of earnings and free cash flows moving ahead. We also expect to monetize our embedded equity in aircraft assets over time, including our 2023 forecast of between $25 and $50 million US in net proceeds on asset sales. All that said, we expect the business transformation to get to the 2.5 to 3.5 leverage target by the end of 2024. The timing of reaching the target will vary given the nature and opportunistic asset sales. However, we see hitting that by the end of 2024, given our expected free cash flows, that amortization of aircraft debt I talked about earlier, and the repayment of our unsecured credit facility. We are committed to the operating range for leverage in the 2.5 to 3.5 range moving ahead. The range was benchmarked against the peers I outlined earlier, and we believe it establishes an appropriate risk profile that allows for the ongoing growth of the company while also allowing for a return of capital to shareholders. Another thing I want to point out is that accretive acquisitions could lead us to temporarily exceed our leverage target for up to 24 months. But as demonstrated this year and our commitment, we are committed to deleveraging, and we would ensure that we have an executable plan to return to our target leverage range within 24 months. In order for everybody to envision what the transition to an asset-light model could look like, we prepared an illustrative impact on our financial results. In creating the illustrative example, we recognize our business transformation is expected to take several years to execute and will be lumpy given the varying timing of asset sales. So to give you an appreciation of the value that we could unlock, we assessed the impact of the business transformation against our 2022 published year-end financial statements. Our example normalizes and eliminates the transition period of the planned business transformation, bringing the transformation forward as if we were able to complete it today. In this example, we take about $250 million US plus applicable debt to invest in an accretive transaction in the aviation services side of the business using an illustrative earnings profile we constructed and is contained in our appendices. We also use about $250 million US to fully pay off our unsecured corporate debt, which saves us about $26 million in after-tax interest expense. The remainder of the embedded equity stays within Falco for the time being, given it's expected to take several years to execute on the fund strategy, and we expect a small amount to be invested in the aircraft equity for some time. We've also annualized the preferred share dividend, so it represents a normalized financial year. Overall, we see the transformation adding somewhere between 20 and 45 million in adjusted net income available to common shareholders when compared to our 2022 year-end financial statements. Using our intrinsic value methodology outlined earlier, it adds somewhere between $1 and $2 a share. Of course, we recognize acquisitions could take time and may not fully utilize the proceeds from our monetization of embedded aircraft equity at a given point in time. With that, we see an option to execute on share buybacks to create a similar value on a per share basis or per share or per common share, dependent on the share trading price. The earnings and free cash flow profile also allows for the consideration of dividend and remains within our published debt targets. As we review our options for deploying capital at each point in time as we execute on the aircraft monetization, our disciplined capital allocation approach will allow us to pick the appropriate method at the appropriate time to increase shareholder value, whether that's paying down debt, accretive acquisitions, share buybacks, or dividends. With all I spoke about earlier, I'd like to end my discussion today with an overview of our capital allocation philosophy. We are committed to reaching our leverage target of 2.5 to 3.5 by the end of 2024. As mentioned earlier, we stand at 4.4 at the end of this year, down from 5.4 the year prior, and 6.4 in Q2 2022, our all-time high. We have shown considerable progress on this target this year. We believe it's important to leverage the company so as we de-risk the earnings and improve the quality of the free cash flow profile. We will also consider share purchases when trading at a discount. Demonstrating this commitment, we purchased and canceled approximately 5.5 million common shares to the end of February 2023 on our NCIB program we recently launched in November of last year. As outlined earlier, we feel our shares today are trading at a substantial discount to both intrinsic and book value. Dividends will be considered by management and the board as we progress on our leverage target and will be based on sustainable free cash flow. We understand the importance of the dividend to our shareholders in evaluating their returns and when investing in Chorus. Debt reduction and return of capital in the form of share buybacks and dividends will still leave room for accretive growth on our target of a mid-teens return on equity. The targeted return of equity will lead to a good return for our shareholders. In ending, I would reiterate, management and the board are committed to a disciplined allocation of capital to increase shareholder value as we embark on this business transformation process.
Okay, thank you, Gary. I have one job right now, and you all have to help me out with it. It's to get you to focus on me while the podium's removed, so do not look over there. So next up, we're going to hear from Colin again. He's going to provide some closing remarks. And following that, we're going to move into our Q&A session. And if any of you are tempted to leave, please don't leave prior to that, because we are going to have a draw for some cool gifts that we have. And we would love to have you have the opportunity to be in that raffle, but you have to be in the audience to receive it. So I'm going to pass it back over to Colin. Thank you.
Okay, thank you, everyone. You've had an opportunity to hear from the team. I think you can tell that we've got a group of businesses that are excited and clearly know where they're going. We have a plan. We are excited about where we're headed at Chorus. This is a very exciting time. We've recognized a need for change. There's no question about that, and I hope we've communicated and conveyed well today what our plan is. We have a clear vision and a plan going forward, focused on both our businesses and our shareholders. We have strong and stable cash flow, as you've heard from Gary and myself earlier. We're deleveraging the balance sheet. We're focused on a clear target of the 2.5 to 3.5 net debt to EBITDA. We're moving to the asset-light model, and that's going to take time. We're growing with new funds, as well as organically growing Voyager and looking for adjacent acquisitions. And we're going to take a very disciplined approach going forward. And we're going to deploy capital to what best provides returns for shareholders. And we've set key metrics, as we've talked about. And lastly, there's an absolute significant upside opportunity in our stock price. We've returned capital to shareholders through an NCIB. We're going to consider dividends, as we talked about, in the future as our stock price recovers and we execute on our plans. And I hope today, we're going to do a Q&A here shortly, but I hope today we've done a good job of communicating and conveying where we're headed. So I want to thank you all once again for taking the time out of your calendars to be with us today. Very important. And we're now going to turn it back and move on with Q&A period. Thank you.
Thanks. So the next piece is the Q&A session. All speakers are going to come up and take the stage. And we're going to have moving microphones throughout the venue here. We have 2 separate microphones that are going to be at either end. And if you have a question, I'll ask that you please raise your hand, and I'll identify you, and we'll have the microphone move to you. And then if you can stand and just speak loudly and clearly so everybody can hear, that would be great. So I'm going to ask everybody, all the management team, to come up here and take their seats on the stage, and we'll get underway. Second. Yep. Okay. Okay. So I know we have some questions. Wow, we do. Okay. So why don't we start on this side? Fatty. Lauren, would you bring the microphone to Fatty, and we'll let him start. Thank you.
Okay, thank you. This is Heidi Shamoun from BMO. Jeremy, I just wanted to get back to the presentation you did. Was excellent. You showed us a slide where the life of doing the fundraise. Mm-hmm. Where is Fund 3 in the life of that fundraise? How many meetings have there been done? You've kind of outlined your expectation to close at the end of this quarter. If you can, give us a little bit more color on where we are in this process.
Sure. So again, it's a bit like building an airplane. As you kind of go through the life of fundraising, it shortens up, right? There's inevitability to it all. So our first fund, it's always difficult. So that's Fund 1. You really do have to kiss a lot of frogs to raise that money. The second one, because we transitioned into the US market, was again a longer process. Helpfully, we've now got a base of US investors. So out of the 650 that we raised in Fund 2, 400 of that actually came from 4 big US state pension funds. So critically, when you go to close a fund, you have a first close, but you generally anchor it around your big LPs, your existing LPs. And we're well positioned to do that. So it's not as though we have to go through that long roadmap of 17 crunches or whatever the hell it was. We anchor Fund 3 around those guys. So that's why it gets condensed up. That's why we don't spend burn so many air miles and. So we feel pretty good because of that bedrock we have. We feel pretty good about getting our close.
Okay. What's the kind of repeat investors that you expect kind of in Fund 3 versus?
So as I think I mentioned, we use Evercore to raise up to help our placement. When they did their analysis back end of last year, out of the 650, we thought we'd get about $400 million worth of, they're called re-ups. So, which is pretty impressive, right? So, there's all but one of our big US LPs will come back. The reason why the one other is not coming back is nothing to do with us. It's just they've changed their investment strategy effectively. Did that help to answer your question?
Yeah, that's helpful. Thanks. One last question. I'm just trying to maybe clarification more than a question. Mm-hmm. Throughout the presentation, you've talked about the life cycle of the aircraft and how the combined business can potentially tap into that. What other industrial synergies, reasons exist for the leasing business and ultimately Jazz and the other businesses to be together?
So I think at this point in time, I think we've already touched on the blindingly obvious ones. So, we part out airplanes. Spares is another one. Interesting in today's world, one of the limiting factors to being able to effectively move airplanes on, you get it back from one customer, move on to another one, is actually MRO capacity, those sorts of things. So we're starting to think strategically how we can use the combined pool of assets we've got, if you want to call them strategic assets. MRO capacity is one. Part-out capacity is absolutely one. Somewhere in the middle of all this, a pound to a penny, there's training, all those sort of things. So, we've picked on the obvious ones. I think there are more to come when we really get to it. Once we really, both sides, really understand where the value is and how we can squeeze the pips, particularly to your point, out of the end of the life of these airplanes.
Okay.
Question right here, Jolene, too, if we wanted to.
Okay. It's hard to see up here, but please go ahead.
Hi, give Jeremy a quick, maybe a rester, and I'll ask Gary a question. But so Gary, I love the conviction in the share price, the intrinsic value, and obviously it $3 today. And so when you look at one of your slides had some sort of sensitivity analysis around making an acquisition of 40 to 50 million. So what are your thoughts, I guess? I know you have the NCIB out there, you're active with it, but it's, it constrains your ability to buy, depending on how much you can only buy so much per day and so on and so forth. What are your thoughts on doing an SIB at say, 350, collecting as much stock as you can? Because when you do the math, like 550 over 3, you're looking at an 83% rate of return, which dwarfs, anything that you're able to do elsewhere in the business. And so that's a quick question for you, and I'll hand the mic over here. But Jeremy, just for you, on the funds, just so I understand, how much leverage do you use in the funds? Mm-hmm. And what sort of impact will higher interest rates, so a lot of PE funds and infrastructure funds, if you've used leverage, your returns look pretty good over the last decade. How much leverage do you guys use? A. B, are your fees based on, and your carry fees based on the leveraged asset value of the fund? And how will higher interest rates impact, I guess, your IRR going forward?
Sure. So maybe I'll start first and said first question. So we see our stock prices being significantly undervalued today. There's no question there's a return for purchasing it back. We are balancing right now all our various capital allocation priorities. Debt reduction is the first one. Our return of capital to shareholders through the share buybacks is another. As capital becomes available, if the stock price continues to be where it would be, an SIB or something like that, we could certainly look at. But right now we're balancing all those capital allocation priorities to get the debt down, get the free cash flow profile where we want it, while also trying to buy back some shares at a very cheap price. But as time goes on, if it continues where it's at, that is a quiver in the arrows.
Me? Sure. Okay, so in terms of how much leverage do we have in the fund, bear in mind it's asset specific, so it's not guaranteed by the LPs and all that sort of good stuff. It's very much asset-based financing, non-recourse to the LPs. So we take a pretty modest approach, right? So we typically leverage our assets 60, 65 cents in the dollar. And the reason we do that is that, I guess we've been around a long time. It's a lumpy, bumpy industry, right? And so if you've leveraged the hell out of your asset, you hit the slightest bump in the road, you have no wiggle room. And so, interesting enough, going through the pandemic, that bore us in good stead. So, for example, we never went to a single bank for a deferral of anything through that process because of the modest leverage that we've taken on the assets. Being a bit old-fashioned, most people resort to extremely high levels of leverage when they've overpaid for an asset. It's the only way you can make the maths work, right? So And sort of cardinal sin number one, and some of our competitors who actually suffered from that through the pandemic, surprise, surprise, you can't defy gravity. So very modest on the leverage front. Helpfully, particularly Fund 2 is a very good example. If you look at the unlevered return in Fund 2, it's like 12, 13%. So you don't need a ton of leverage to make that maths work, to get kind of that mid-teens sort of number. Going on from that, we just refinanced Fund 2, and obviously we funded it into effectively into a rising interest rate environment. A year ago, we tried to do an ABS deal until Mr. Putin kind of rolled his tanks over the Ukrainian law. We were doing quite well, thanks very much, and then that disappeared. So obviously we paid the price, but interestingly enough, we had a pile of assets in Fund 2 that weren't levered at all, but they had a high basic yield. So even having absorbed increased costs by about a couple hundred basis points, sort of round numbers, we're still going to hit mid-teens return. If you go beyond that, and we're still in the mode of deploying capital in Fund 2, granted we make an assumption that we can leverage things at 65 cents in the dollar, instead of it being 500 basis points all in a year ago, it's now 700 all in today. In our world, what's quite interesting, and hopefully the dynamics of our industry or our position came across in my slideshow. In our world, it's dramatically different than the narrow-body space. The narrow-body space there's just a wall of money chasing that market, absolute wall of money. Christ knows why. I'm probably not going to say that, but anyway. Lord knows why, because the maths doesn't sort of make sense, right? And in simple terms, if you think about it, in my world, on a new airplane, I can probably go out and buy an asset and get a 9-10% gross yield, sort of on a long-term lease. If you look at a narrow-body space, if they can get a 6-7% gross yield on those assets, they're sort of doing well on a shorter-term lease than we might get, right? So in that world, in their world, because of the wall of capital that's flowing into, it still continues to flow into that arena. And if you looked at one of the graphs we put up, you'll actually see the returns in the index, the Serum index actually coming down. That's part of the reason. Their net is coming down because they're not able to actually pass on the incremental cost of debt. In my world, we don't have a lot of competition. So when Mark, who's sitting right behind you there, goes out and buys airplanes, we just factor in that our all-in is 7% and we need this equity return, and that's what happens. But it's purely a function of the supply and demand of capital. Does that answer your question?
Okay, thank you. I think Matt had a question in the front here. Matt Lee.
And then we had one right here next, I think.
Okay.
And right there.
Hi, thanks. It's Matt Lee, Canaccord Genuity. Just given your industry expectations, Jeremy, and maybe some of the increasing rate and pressure, are you seeing any opportunities to maybe acquire aircraft at a higher unlevered lease rate to potentially improve that IRR above that mid-teens rate that you kind of suggested?
So without giving away specific transactions, if we look at the transactions that we have done during the pandemic and post-pandemic, that's probably the best way to look at it, they're all centering around 18, 19, 20% kind of zone. So the short answer is yes. Now, part of that is less competition, which is sort of helpful. Part of that is we have dry powder we can spend and all those sort of good things. But face value, we're able to go into the market and pick up deals today, because we're about to close one very soon, where we're going to deploy 50, 60, 70 million bucks worth of equity. And that's got an embedded IRR of 18, 19% sort of zone. So the short answer is, yeah, we can average up, right?
Okay, I think Hillary had a question here. And then we'll go to Cameron.
Thank you. Hillary Kagananda from Deutsche Bank. Just given the recent banking crisis involving Silicon Valley Bank and Credit Suisse, just going back to Fund 3, I was wondering if you've seen any changes in investor sentiment or investment interest or willingness to get involved.
Short answer is no. Bearing in mind our capital we generally go fishing in the big U.S. state pension fund market. our capital comes out of their illiquid bucket rather than the liquid bucket. They've still got plenty of capital to spend. One of the limiting factors in today's world, which I'm sure you're acutely aware of, is the dreaded denominator effect, so the proportion of liquid to illiquid that they can have in their portfolio. That's something that we bump up against, and most of the response from the big US state pension funds, surprise, they're moving the limits because actually there's plenty of investment opportunities. So short answer is no. I think the only time we've come across, nobody's, other than everybody running around about, it was 2 weeks ago, trying to figure out whether we got any deposits with Silicon Bank and all that stuff. No. The only time we've actually observed them not even in our space, but at least in the fund space, is they did a lot of capital call lines, subscription lines. We have our subscription line from a different bank, so that's kind of a good news event. So short answer, we see no nervousness or pushback on the part of our investors. Right? They're obviously keen to know whether or not we're exposed, but other than that, short answer is no.
That's good to hear. And then just a second question regarding crossover assets. You mentioned, crossover assets like 8 to 20s have been very popular. So, as they increasingly become considered more of a narrow body and become popular with more of a traditional lessors like AirCap, Air Lease, what are your plans with those type of assets? Are those, do you envision them still being your portfolio, or do they kind of come out of your portfolio as they become more popular, more mainstream, I guess? The narrow body.
The short answer is, I don't know if that was a question for me, but whatever. The short answer is we're agnostic, right? So put crudely, and what we chase is value. We're very, very focused on price, return, credit, right? So we'll put our hand up for every RFP that's going with a 220 or our whatever else it is. If we can't get the numbers we want or need, or we think it economically makes sense, we just don't do it. I mean, we had a great example, probably pre-COVID sometime or other. Far Eastern airline, very prominent, very successful Far Eastern airline, put up an RFP for, it's probably Q400s or something. Part of the relationship is you want to be in that flow and responsive to your customer and all those sort of good things. So even went to the point, I flew all the way out to the Far East just to meet the CFO because the decision was looming and all that sort of good stuff. All fine. We submit our number, I get in an airplane and fly completely the wrong direction, but that's sort of by the by. He rings up the next day and says, this is a bit of a difficult conversation, Jeremy. Okay, whatever. And he said, yeah. So we've had 34 responses to our RFP. You're 34th. Would you like to rebid? The answer is, no, we're quite comfortable at 34. That's where we want, that's our number. And he just didn't get it. But we are very, very disciplined. I mean, as you see, we've seen $30-odd billion worth of deals since over the last decade or so, and we picked out about 10% of that. So we're not going to get carried away just because everybody else is doing it. So be it. If everybody else is willing to settle for lesser returns that we think are appropriate for the risk we're taking, you're kind of on your own. And interestingly enough, I'd say two things on that score. One is we've seen many a deal where we've had a raving lunatic go and compete with us and bid for some assets. Funnily enough, they couldn't go and get the decks. They basically overbid, and the deals come back in our direction. And I'd say the other thing is the inevitability of it all is those deals just they go finance and it's like, oh Jesus, if only I'd known it was this, I never would have done it. And we sort of pick it up on the other side as well.
Thank you. Thanks, Hillary. Would you mind passing the mic just to Cameron there, please? Thank you. Behind you. Yeah.
Hi, it's Cam Dirks from National Bank. I guess a couple questions for Jeremy. Laid out a pretty compelling case here for the asset-light model of leasing. Correct me if I'm wrong, but I think the majority of, leasing in the industry is more sort of the traditional model.
Yeah.
So why do you think we don't see more of the asset-light model out there? And I guess maybe a related question is, what do you think the barriers to entry are for that? I mean, it sounds like your expertise, which you developed over many decades, is a key one, but can you maybe just talk about some other barriers to entry that might be the case in the asset-light model versus traditional leasing?
Yeah, so, I can't really say why others haven't adopted it, but it would seem to me, certainly if I look at many of our competitors, Their primary goal is to build something of scale on a balance sheet and all that sort of good stuff. And their exit is to sell a business, right? And I think that's kind of part of it more than it is anything else. And I think it may be wrong, but actually raising the capital from a big PE firm in a single bucket and putting assets on the balance sheet, face value might be a whole lot easier thing to do. What I would say in response to that is interesting, right? So if you look at those people that had to have suffered through the pandemic or otherwise, what tends to happen if you build the business on a balance sheet, you start to build a portfolio, you lose you lose focus on the individual merits of an individual airplane or an individual deal, because you're trying to average up or build a and all those sort of good things. And so you start to compromise your returns because you're just trying to build this either for scale or some rather strange identikit portfolio because you want to go and do an ABS deal or you want to sell a business or something or other. The real discipline about being in a fund structure is you have to be razor focused on each of those investments all of the time because you report them absolutely every quarter. I think what it also does is it makes you really focus on releasing value, because there's an inevitable, you've got to do it because you need to turn the capital over to generate the returns to get more capital. So I could make a very good case that actually the fund type structure creates more rather than less discipline about how you go about investing. It is much, much more detailed. There's great more visibility about kind of what you're doing, right? Barriers to entry on that, I think there's a couple of things, right? There's barriers to entry in our particular niche, like the kind of regional aircraft leasing niche, undoubtedly. And then the barriers to entry, you're right. You have to build up a track record, difficult to do. You have to build up relationships with big US state pension and all those sort of good things. And a lot of it is personal, frankly. So there are meaningful barriers to entry. And I think the other challenge, particularly for some of the big guys, the guy who play big boys toys, right? And there are a few of them out there who've actually tried to switch their model and go from the balance sheet model to a fund type model. The real challenge they have is the returns they generate from leasing narrow-bodied airplanes and all that sort of good stuff. They're never going to hit the numbers that a US state pension fund will want. I mean, the magic number in the US state pension fund world is typically 12 net, right? So if you start off with 6, 7 gross on the asset in the narrow-body space, Lord only knows how you get to 12 net. The maths doesn't quite work. Is that okay?
That's great. Thanks very much.
Great. I think we have a question on this side of the room. All right, David, go ahead.
Thanks. David Ocampo, Cormark Securities. Jeremy, you're on a roll, so I'll just start with you. I mean, the landscape for regional aircraft leasing has changed quite dramatically, but aircraft sales are still a cornerstone of your business. So I'm just curious who you're selling the aircraft to, since airlines are looking to lease more aircraft and there's fewer players in the leasing space.
So kind of 2-3 places, really. So there is because we didn't put it up, right? There is actually a myriad of smaller lessors in our space, right? They could go buy a 10 airplane deal. They couldn't do a 50 airplane deal. Now, might be able to raise the money for a 50 airplane deal, but that's kind of 25% of the story. The real challenge you want to go into a big deal, the sorts that we do, is you need the infrastructure to be able to manage the process and everything else. So, there's a myriad of smaller lessors in our space who can readily absorb, 10, 20 kind of aircraft deal, right? The other interesting thing we learned going through our sale process, whenever that was, like 18 months, 2 years ago, is the degree of interest in the financial world around this space, investing in this space and all those sort of good things. There's when we did our Falco process, we must have had like 24 some bids, which is a ridiculous number, right? Very flattering, creates a lot of work, but that's sort of about it, right? But what it gave us was a really healthy Rolodex of people, financial investors who you can go and trade these assets to. So, in the case of Fund 2, for example, we have like 12, 30% gross yield on the assets. If you want to play the yield compression game, then there are plenty of people out there who would take them at 6 or 7, right? fill their boots all day long. So one of the things we are actively doing, which is more air miles, but we're actually nurturing that investor base as well, both from a debt and equity standpoint. So, I think DB are in the room here somewhere. We spend a lot of time going around the structured finance conferences and the ABS conferences because there's a lot of capital out there that's very interested in this space and the economics in and around this space. Is that okay?
Yeah, that's perfect. And then the second one is for Randolph on the CPA.
Thank God for that.
We see a step down starting in 2026. So just curious if you've had initial discussions with Air Canada on backfilling that revenue, because eventually we're going to start modeling out to 26. And should we assume that step down, or are you guys going to backfill?
In terms of the fleet, so we have a fleet commitment from Air Canada in 26 of 80 aircraft of 75 seats or more. That's the minimum fleet commitment. And so we have the current fleet that we have of 114, and we're working through with them as to how we transition some of those aircraft, but there's been nothing concrete right now. And in fact, most of the focus right now is on taking advantage of the next 12 to 18 months in terms of the passenger demand and meeting that passenger demand.
Okay, thank you.
Thank you. Okay, Konark, right in front of you there, Amanda. Thanks.
Okay, thanks. It's Scotiabank, Konark Gupta. Thanks for the presentation, guys. Very informative. Maybe the first question, probably for a change, Jeremy, I'll ask Gary first, the CFO. So, Gary, you have an illustration in your slide deck on acquiring a few businesses at 7 times EV/EBITDA. That creates a value of $1 to $2 per share. Pretty sure there's tons of businesses out there at 7x that you can buy. But what's really your focus? Like, what kind of assets are you guys focusing on for that M&A value creation?
Maybe.
So maybe I'll actually let Colin
should
answer
take
it
that.
on the
Yeah.
regional side, but we're looking at those adjacent companies Colin outlined earlier.
Yeah, so there's, I think I provided a bit of a list there. There's a wide range of opportunities for us, and it's really not limited to any individual vertical. We've been looking, and we are in the process now of starting to spool up and look at and evaluate opportunities. And our biggest thing that we're focused on as we move forward here is our discipline in capital allocation and making sure that we really understand the businesses and that we understand what kind of returns we're going to get. And that, for us, is fundamentally the biggest shift as we move forward here in the next little while. What Gary's exactly modeled, I think Gary should probably speak to, but I wouldn't put any confines around anything in aviation and say that, it's going to be within this box, because we have a very broad spectrum of things that we're looking at. And there are many things that will fit within our business very well. The fundamental, though, is what I talked about earlier on those slides, is a business that fits well with us and that's consistent. We don't want to be back in a business that doesn't align well with, and a good example is our balance sheet. We want to make sure that whatever we go into is providing good, solid returns. We understand the business really well, and that it aligns with our organization.
Okay, thanks. And back to Jeremy, actually. So one question I was wondering was, when I look at your competitive landscape, Nordic Aviation is shying away from regional, going to narrow body. GCAS, AirCap, clearly not focusing on regional. You are the only sort of big guys out there focusing on regional. Now, Dash 8s are gone, no production. CRJ is gone, no production, right? You only have maybe ATRs to some degree. Embraer E2s, right? And I don't know, A220, I would call it, crossover / regional, right? Like, would you be forced one day to kind of, get scaled up, look at the narrow body jet market, or can you kind of, with this production environment we are in right now, can you still continue?
So there's probably a couple of sort of myriad of topics there, right? But short answer is, I probably said too much. I probably gave you too much of a view on the returns in the narrow body space. So, if I can't justify them to myself, there's no way I can justify that to my investors. And as I said before, I think that the net return you can get out of leasing in the narrow body space is not going to marry up, certainly to my investor base, right? So, short answer is no. I think that's probably a bit of a fool's errand, frankly. And so, and the question, the next question is, well, Jesus, well, how are you going to fill the fund up, right? As for example, it's 100 airplanes, 120 airplanes. We fish in a pool of 9,000. There are still airlines out there doing sale leasebacks to release up airplanes. There's 390, 400, pick a number, 500 airplanes somewhere between AirCap and NAC that will get freed up. So we can have a lot of fun with that as well. There are other competitors in the very same space, which are sizable, who we know have tried to trade their portfolios in the last 18 months. So we're not short of opportunities. You know, the thing you have to be, you have to be very brave, right? Which is better to do no deal than bluntly a crap deal. So it's better to do no deal and better to not get carried away just because somebody else, like an Azure, has pulled off something, some deal. The answer is, well, it's all very interesting, but we have to be incredibly disciplined. And that's obviously built the track record that we've got. Our investors appreciate it, our bankers appreciate it, and I still maintain there's plenty of opportunities, even with the limited production line that come out of the 220 and the E2.
Okay. I think Kevin has his hand up there for a question.
Thank you. Kevin Chang from CIBC. A leasing question, but maybe this doesn't go to Jeremy. You're going asset light, but your leasing business is really 3 leasing businesses. You have one with Air Canada, you have your legacy one with CAC, and obviously you've highlighted why Falco was your growth lever. But what happens with the other 2? Like the owned assets you have over time, like what are your intentions with that? And then is there a way to fold in the Air Canada leasing business into a more tax efficient structure? Because I think CAC offers you a more tax advantage return than the leasing revenue you get under the RAS segment.
I'll just give the initial kind of response on that. When you think of our businesses, all of our operating businesses have leasing as part of their business operations, and that includes even Voyager. Voyager today does lease aircraft to third-party companies. And so we will always have some integral leasing within our operating businesses, and we look at those somewhat separately. And the Jazz operation over time will change. There may be an opportunity here in the future for us to lease in new aircraft, or there may not, we're not sure. But we're very well protected with those current leases that we have within the Jazz book of business. And likewise, within the Voyager book of business, we have a plan where you can get clear vision on exactly what we're doing with those assets. So we see those businesses somewhat separate, that leasing portfolio is somewhat separate from what Jeremy's got within his vertical. That's not to say that we wouldn't leverage across these businesses to leverage the capability that Falco brings to the table. And we have actually started to, there's been a few opportunities, and Carl's been involved in those recently, where we've been looking at bidding on new contracts that utilizes and leverages the capability that Jeremy has with the capability that Voyager has, because these contracts, some of these contracts require both. So I think you would want to keep looking at it as a separate, that the book of business is very separate from what we're doing within the leasing business. But I'll let Jeremy and
as far as transferring it into a more efficient tax structure, that's possible. I just say that those assets have provided tax shield under our CPA. We earn a lot of income off of that, and that pool of assets has accomplished that. So from that perspective, it actually is tax efficient. Now, as we move to the the secondary leases and beyond, then we will assess it.
Maybe just two more clarification questions. You talked about utilizing or deploying your excess free cash flow, and you talked about NCIB, maybe a SIV, and obviously acquisitions. But just thoughts on simplifying your capital structure overall. You have the prefs in there. Is that something you would look at over time as something you'd want to deploy excess free cash flow towards, given its higher cost of debt to you?
Yeah, that's a good question. We'll look at that at the appropriate point in time. It's essentially, it has a step up after 6 years, so it's 20 2028, essentially, when it steps up. But it's at 8.75%, and if you look at our return on capital, or sorry, our target for ROE in the mid-teens, and you start to look at that, there is a spread you could still make by using that capital, even if you did have surplus cash, rather than pay it down, deploy it to the accretive acquisitions. But it's on our radar, but it's not something that's front and center at this stage. Right now, it's debt reduction, getting that to our levels, supporting the share price, and buying back some shares where we can under the NCIB. SIB is always an option as we free up capital from our monetized assets and start to get a better quality of free cash flow from the pay down of debt.
Okay, and I'm going to ask a question for Gary Gilbert actually too. What percentage of business do you think in the other segments you could be servicing that you don't service today? It sounds like you're kind of just touching the tip of things you could do. You know, you highlight some examples with Falco and other parts of the course, broader corporation. But is there like a quantum that you see that's just, hey, we should be doing that, but we don't because of whatever the reason is? Is there a way to quantify that opportunity?
I don't think we could really quantify it at this point, but you're right. There is definitely some opportunities there. We are in discussions with Falco to help them with their procurement. With the Q400 in particular, they got some lease transitions that they're going through, and we're going to help them with part support and all that. And then Jazz also has a Power by the Hour program that is with de Havilland. We've looked at it as well to support them on that. But at this point in time, we're not really in a position to take that over. But there is absolutely, and we do have some back and forth between us and Jazz. They supply us with some parts sometimes, and we certainly supply them with some parts. But there is more and more opportunities for us to look at and grow that. But right now it is fairly small.
Okay, a show of hands again. I think Bruce down in the front, I see you. Lauren's going to pass you a mic, Bruce.
Thank you. Bruce Murray, the Murray Wealth Group. This is sort of an esoteric question, but with the inflation we've seen in the past couple of years, it would seem to me the residual value of your fleet, maybe just speculate on where the residual value of the fleet moves over time with this sort of stuff.
Do you want to answer
Would you like to take that, Jeremy? Yeah.
So the interesting thing about regional airplanes, probably more so than certainly wide body, narrow body, is that the lion's share of the value is actually driven by engine value more so than anything else. So if you look at an E190, for example, by the time you get to like a 15-year-old airplane, the value is pretty much covered by engine value, like them, right? Some of the two engines is about the same. An appraiser would tell you the whole lot is, right? The great thing about engines is that the reserves we get on those engines inflate over time because they base back to the OEM cost of actually overhauling that engine. So interestingly enough, inflation is helpful, right? For that very reason only. And then of course inflation is helpful because it creates, on new airplanes, they escalate, right? So the OEMs have escalation factors on that, so they escalate. So perversely, it's sort of helpful, right? Yeah.
Okay, another show of hands. Okay, right here, thank you.
Thank you. Tim James with TD. Question, fairly open-ended, actually. I'll ask it to both, maybe Colin and Gary can take a shot at it. Can you talk about the risks? What are the things as you look across the business as it sits today, and you've highlighted it's changed quite a bit, but what are the kind of 3 or 4 items that you really kind of are watching closely, whether it's, labor challenges or cost of capital? Just be curious to hear what you think are the key risks to be cognizant of.
Yeah, it's a great question. Obviously, the financial side of the business is a primary focus for us, and I'm going to leave that to Gary to talk about there. But when we think about the bigger business, the things that we need to be really good at and manage well are things like safety. That is a primary focus for us. The other area that is, I think, quite common across the operating side of our businesses, besides the financial side, is when you think about employees and you think about talent attraction and you think about labor risks. And those are things that, we spend a lot of time on. We spend a lot of time managing, thinking through, and being very clear about kind of where we're headed with our employees. The value of Chorus, as we heard today, is really in the talent. It's in the human capital. And you heard Jeremy talk about it. You'll hear it at Randolph. You'll hear it at Voyager. And it's really all through the organization, right to Chorus. And that, for me, is fundamentally one of the most important things that we need to keep an eye on, is the human capital and making sure that we have clarity on our leadership and the people that are coming up through the organization. And so for me, that's a top priority. Obviously, the things we talked about today are also key to us, and the financial side of the business and how we've shifted our thinking here in the last little while is very important. I'll let Gary add to that.
Yeah, as far as managing the risk, we've been deleveraging, as we talked about, and that's a key for us, that de-risks the company. And then to improve the free cash flow profile is really where we're going. And as far as other risks like foreign currency and other things like that, we manage those well. We match all our currencies and to the underlying debt payments so the revenue and the debt are matched. We also, on the interest rate side, fix most of our debt, well over 90%. So from the risk side, we manage that. It's now about deleveraging, repositioning the company to prepare it for its next run. Yep.
Okay. Sorry, go ahead, Tim.
Sorry, I was just going to say a second question, probably for Jeremy here, I think. The well-documented sort of pilot shortages that we're seeing in many regions around the world, is that coming into conversations at all with, whether it's potential leasing customers or investors, or is there just a longer-term view that sort of assumes that fixes itself? Do you think, is that impeding the business at all today?
So in taking that sort of in reverse order, although my friend on my right is better qualified to answer the pilot issue, but it will fix itself over time. The investment that major airlines are making to deal with that problem is, you can see evidence of that. And we've just started a flight school, for Christ's sake. So people are systematically trying to fix that. It's when rather than if. If you look at where most of the regional airplanes are deployed, 2/3 and round numbers are North America and Europe. North America obviously is hamstrung. So interestingly, if you see a lot of the carriers, a lot of the big US carriers have parked big chunks of their regional fleet. However, if you wanted in to see them and said, are those airplanes for sale? The answer is absolutely no. They're not going to sell them because they're not looking about, worrying about this year. They can see that we're going to get through this, and these are critical assets for their overall infrastructure. They're not going to trade them because they'll never get them back, and there aren't many replacements. So the US market is somewhat different from that standpoint than Europe. We don't see the same pinch points in Europe around pilots at all. The bigger issue in Europe has actually been around infrastructure more than it is pilots. So there's some crazy stat out there somewhere, which I'll get wrong, but I might as well just chuck it out for fun, is during the pandemic, they lost 50% of the ground handling staff across Europe. 50%. Go figure that out. Try and replace, and they've all gone off to be Amazon drivers or whatever they've done, right? Getting them back is a long haul, which is why we see, and I suffered it last week in Heathrow, the delays and all that sort of good things in and out of somewhere like Heathrow are pretty desperate, but it's all in the ground handling. It's not cruise particularly. So strategically, airlines are keeping their assets, even in the US, where there's lots of 175s and 200s and all that sort of stuff. They're keeping that strategically. They're important long term. They will get through that the bottleneck. It's when, not if. Has it affected us particularly? Short answer is most of the assets, we haven't got many idle airplanes, full stop. North America really hasn't been a great backyard for us from an investment standpoint anyway, because most of the big major airlines in the US can go buy airplanes or finance airplanes and the cheaper cost of us leasing them airplanes. So guess what? Very few regional aircraft are actually leased by third parties in the US. We got lucky in the pandemic and picked up a few at very handsome returns, but it's not a significant hunting ground for us, come what may. As to placing airplanes into the US, you're absolutely right. So difficult to place airplanes into the US because nobody's going to take more if they can't fly them. But our fleet today is not particularly challenged from that standpoint. We have a very limited number of airplanes which would naturally, assuming we had them idle, would naturally fit into the US market. But we have plenty of other homes for them. So short, probably a long-winded answer to your question, but short answer, it doesn't impact us from a resale, so a kind of releasing standpoint. And it will right-size itself. It's inevitable.
Okay. So it's shortly past 12, so it brings us to the end of the session. But we do have lunch that will be served in the same room out here that's the breakfast was served. And the management team and also members of our board will continue to circulate. So if you haven't had an opportunity to ask your question, you'll probably get to do it one-on-one. So thank you all very much for attending. We really appreciate it, and have a great day.